Hi, I'm Martin. I'm the Corporate Finance Director at Gravitate.
And my name's Luke. I'm the Tax Director at Gravitate.
So we thought we'd just do a quick, or see how quick it is, to be honest. It might not be quick at all. Talking specifically about growth shares. So we've got some topics here, why it's important, what clients should be thinking about. So we just put together a few questions. We're just going to have a chat about it, and hopefully it's helpful.
Yeah.
So let's have a look at the first question. So why is it important to find incentives for staff retention beyond just increased salary?
Yep.
You want to start off?
Yeah. So we're seeing it quite often where SMEs are generally wanting to retain their senior management team and incentivise them. Because if they left, there would be a massive impact to the business, especially if they move to competitors. So instead of just having a salary, maybe a bonus scheme, tying them in with some form of equity arrangement, probably is the best way of putting it, is a great driver to kind of keep them long term, potentially towards an exit or an MBO or anything like that. And it also really helps with promoting the manager or management team to think about sort of shareholder value rather than just their own sort of salary and remuneration.
And I think people are just more in tune with wanting to understand what's on the table as well. I see this as a real opportunity for, when we talk to business owners, what's the one thing they always argue about or have problems with, particularly in this day and age, it's retention of staff, but also how do we get the staff in? How do we attract them? So if you're really thinking about, okay, look, most employees want to be well paid, etc. But if you're building this into your package at the beginning, at the outset, and understanding what it is and what it means for you, what it means for them, building that understanding piece right at the very beginning, we'll use it as a tool to try and get the best talent as well, I think. So it's about retention, keeping people tied in, but also use it as a tool to get the best people in the first place. I think, but having that knowledge and understanding and really thinking about building it into that first phase when you're talking to people, I think it's quite important.
I agree. And probably the other thing that we'd probably say would be, even if you're looking at your current management team as well, if you're looking at expanding and you need to bring somebody in as a bolt-on for like a specialist arm of the business, these sort of options are great as well, because it may be that if the current entity doesn't have a specialism in a certain sector or field or a very niche new sort of element of the business, then getting somebody in who's a specialist is great. The remuneration might be quite high, but the equity option is potentially what is really beneficial for them to really sort of grow that division. And they can kind of lean on the rest of the business to do the non-value add side, and then they can really build this sort of excellent arm to the business, which only adds value to everybody, really.
No, I agree. So I suppose a specific then, there are different types of sort of share options. So I suppose the next question is, what are growth shares and how do they work? I suppose pointing on thinking about the risks as well and rewards for the current shareholders, why they're a good thing for them and why they're a good thing for the employees. So what do you think about that?
So the sort of the basics of growth shares is, if we use an example, if we've got a company that's currently worth, let's say, £1 million owned by you, Martin. You're looking to bring somebody into your business and you want to give them equity, and if you just gave them, let's say, 10% of equity, then I would be taking out, let's say you was giving it to me, 10% of that, £1 million would be, let's use these figures and say it's £100,000. Straight away, I've got a tax charge on that balance, and although I've got the value of the shares, at day one, I've got no cash to pay that tax charge. It's a dry tax charge and not something really palatable to getting somebody through the door. So what's becoming more and more common that we're seeing and sort of hearing from almost every meeting we're having is growth shares. So how growth shares would work is essentially the new person would only realise value above what we call a hurdle. So if Martin's business is worth £1 million and he was on trajectory to hit 1.5, they may set a hurdle for me at 1.5%, where I come in and I get 10% or 2% or 11% or whatever above that hurdle. And then that really drives me to really build the entity so that I'm participating in value above that hurdle. And if I sit on my laurels and don't do anything, then I'm not going to participate in value in equity, because we're going to hit the 1.5 and I've got nothing. So it's really a carrot to dangle to really push people to sort of hit those growth targets. Obviously, there's a debate over what percentage you give and where you set this hurdle and how you want it to motivate. but they're an excellent sort of tool to secure the current directors, co-founders' value up to today, or the sort of trajectory for today, whilst helping build a springboard for sort of the next stage in the growth pattern.
And if it's, if I'm the main shareholder, it's my business as well, I feel like I'm only giving shares based on growth.
Yeah.
So even though I've had to dilute, I'm in the same net position as I was, but the company's grown. So
exactly.
It works really well, doesn't it, from that point of view?
It does, yeah. If you had to an exit in 5 years and you only hit 1.5 and that's my hurdle, you've not lost any equity. So in that way, you've got strong protection. And if we build it up to 10 million and I participate in 10% of that value, you've still got your original hurdle plus your 90% of the growth. Yeah. So it's got really strong sort of incentives for the new person to sort of build value, whilst also sharing the value with the co-founders or the rest of the shareholders.
Yeah, so and for me, it's just like you say, you touched on it. You've got to really think about what those milestones are along the way as well, and what that growth target is. And if you work with advisors to work out what that right number is, again, it's all about reducing risk for the current shareholders whilst incentivising these key people in and giving them a longer term goal, and at the end of that goal they're rewarded with share ownership, really, or part share ownership.
Yeah, exactly. And that sort of may lead on to an exit for all parties, or as we said earlier, it may lead on to the sort of growth shareholder or shareholders doing an MBO, potentially, dependent upon the unique circumstances.
I just think it's particularly for service-based industries, you really should be thinking about this, because motivation's really key. You've got to get these people motivated, and it's a really powerful tool to get people motivated in the longer term, not just short term. Yes, you've got to the right salary, people have got to pay their bills. They might want bonuses instead of growth shares, but I think if you've got it on the table as an option, then again, it's just putting you ahead of your competitors in terms of getting that best talent in, I think. That's
definitely, It can set you apart from the competition, definitely, because if others are potentially looking to offer that and you as an employer aren't, then you may be falling behind, and there's only so much that an additional amount of salary can do, plus that's probably not the most tax efficient way
of doing it.
Yeah.
So then, I suppose we touched on the benefits there. So drawbacks then, well, I think a lot of the time it's probably costing, isn't it? There is a cost to implement these sorts of things, legal, financial, to get them right.
Yeah.
We would always argue that the upside's worth it in the long term, and I think you always use the analogy of, well, how much would it cost to sort of recruit somebody in, and what the costs associated elsewhere.
Definitely.
If you get this right, it pays for itself anyway.
Yeah, I agree entirely. I would always look at it as, if you are securing that key 1 or 2, maybe 3 people for the next sort of growth stage of the business, if you want to lock them in for the long term and you're wanting to give them equity, then these options that we're looking at are a fantastic tool.
Like you say, the potential drawbacks. I think for me, that there aren't really any. It's the time and effort to think about the best way to do it.
Yes, there are upfront costs to setting the scheme up, but I would always look at them as an investment rather than a cost, in terms of, if said person left, there's the cost of recruiting, there's the cost of getting somebody in and just going through the learning curve. There's the sort of unforeseen loss that said person may have if they move to a competitor. The sort of contacts and the knowledge that you're losing alongside it. So it's hard to put a number on what the cost would be if the person left, but it almost certainly would be far less than the investment that you're taking in. And how do you put the number on tying them in? And if they're helping you grow it and you're appreciating X% of the growth, which you wouldn't achieve without them, then that's normally an immense number in comparison to these figures here. Plus, as well, you've got the consideration that if you invest into them, and even if the growth isn't significant, if you're not giving any equity away, you're in no worse position than you were before. But what we're normally seeing these in is obviously the businesses that are really pushing for growth. You probably wouldn't be having the same conversation as if you were kind of a business that were happy with the status quo.
Okay, good. So benefits, drawbacks. I suppose we touched on growth shares there. There are some alternative schemes as well. So is it worthwhile just briefly talking about?
Yes. So the main other one, as Martin says there, is the EMI scheme. So EMI is a tax incentivise or tax advantaged option scheme whereby the value is agreed up front with HMRC. So you would undertake a valuation. Yeah, we would apply to HMRC to agree the valuation of the shares and the options that we're looking to exercise or grant, should I say, to certain members of staff, and they would often come with criteria that they have to meet and potentially a vesting period where they cannot exercise for a period of time, or potentially there could be exit only options so that the employees stay, and then if there is a sale in 5-6 years time, they can acquire the shares at the grant price that you've agreed and hopefully exercise or sell for a much higher figure. So EMI is a really good scheme. It's been in for probably 20 something years maybe. It's been a long time. Probably not as popular as growth shares at the moment in terms of what we're sort of hearing on the grapevine, but it is a great scheme, and we always kind of look at both when we're having a chat with clients. The sort of only thing to consider with EMI is there are sort of criteria for the company and the individuals that are sort of within the scheme that you have to meet, and sometimes the company may have grown to a stage where they can't participate. At which point, if they can't hit the sort of the size criteria, or quite often the sector, so sometimes there are certain trades which cannot participate, like for example accountancy and finance. The trades are restricted from entering into EMI, so that's why a lot of businesses are now looking at growth shares, because that is kind of the
flexibility.
Exactly, it's got more flexibility, and I think that flexibility is what people sort of strive for. But sometimes there are advantages that EMI may have that growth shares don't, that people may want. So it's always good to kind of have both on the radar.
I suppose the last point is, one of the last points we've got down here is why is expert advice really important? I think, it's fairly self-explanatory, but what we've not touched on that much is the key link to succession. For me, the growth shares, why I get quite excited about them is, often I'll be talking to buyers, and if your business that you're trying to sell, for example, management are quite key. Well, if they're tied in with growth shares, it gives the buyer comfort that when they acquire the business, those individuals are less likely to move on. So again, it's all thinking about long term. That's what we try and do at Gravitate quite a lot, is think about that longer term plan. And again, linking back to that expert advice. It's expert advice, but regular touch points as well, because your business is moving all the time. With these key individuals, you need to be having conversations with your advisory team about this stuff on a regular basis.
100%. With whether you're looking at doing growth shares or whether it's looking at EMI, you want a solid sort of tax, legal and corporate finance angle in every deal. We've seen and we've come across a few where clients have done a sort of, let's call it an informal growth share scheme, and there are risks with everything, but where there's not been strong advice given, the risks are significant, and essentially at a later date they could come under intense scrutiny from HMRC, and there may be significant tax charges, which kind of unwinds a lot of the benefit that we're trying to achieve here.
Even if you're, if they've not been done correctly at the outset, when you're looking to sell as well, again, a buyer's going to look at that and use it as a tool to sort of negotiate from, or these shares haven't been put in, the forms haven't been, so you're just opening yourselves up to a hefty price chip when you come to sell. So there's lots of reasons why it's really important to get it right from the outset, I think.
100%, and with the right team, do you know what I mean? Like we say, it's an investment to get it done right, make sure the value is robust, because even with any sort of valuation, there can be scrutiny on it, and we want to make sure that it's a solid valuation that can be backed up now and in 3 or 4 years' time, should it be queried. So we really don't want sort of a routine valuation that can be easily sort of tackled.
And I think as well with the clients that we're working with, where it works well is where you're sitting down with them when they want to roll this out as well. Because it really feeds into that growth mindset. Well, let's think about growth shares, what we're going to do for this particular situation. Once we've got the detail nailed and we're happy with the criteria, well, there's no reason why we can't replicate that more efficiently for next time. And it just adds to this expansion of growth, and that's where I see the real benefit as well.
Definitely. I think it's a great package, a great thing to consider, and it's probably a discussion starter, let's say. And it's probably that you're not going to have everything outlined on day one, but we can certainly signpost you and steer you in the right direction. We've got the connections for the legal aspect, and basically it can be a great tool to help take your business to that next level. Whether it be one person, two person, three people, several, there are sort of, the options are open and endless, and it can be tailored exactly how you want to achieve your objectives.
Perfect. Okay, so yeah, just wanted to do a quick summary video. Hopefully that's been helpful. Just get in touch if you've got any queries.
Yeah, thank you very much.
Thanks.
Thank you.